if you're doing a deal and you're raising equity, raising that extra, 10, 20, 30K to put into the bank to take care of interest payments as a safety net isn't, it's not the end of the world. So just raise that equity from an investor, pay him his return, put it into the account. And then once you're at the point where you can finance it, negotiate it as long a timeline as you can, right? If the project's going to take 12 months, ask for 18. If it's going to take 15, ask for 24.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, John Cohen. How are we doing?
Good. With everything going on, we're gonna be able to fill up our podcast schedule because we gotta
exactly.
over the next couple of weeks. We just have the inundation of people that have been a little bit slow to respond, but we have all the time in the world now, so it's ready to roll. So I'm in podcast mode.
Yeah, there we go. We do have a great guest on today. I'm excited to get started and hear his story. But very quickly, if you guys have not already heard, John and I are going to be speaking for a charity event benefiting Leukemia Lymphoma Society, LLS. It's called the Long Island Real Estate Revolution. Originally, it was supposed to be an in-person event, pay to get in with all proceeds going to LLS. But because of coronavirus, we have totally shifted gears. We're going 100% virtual and 100% free. So if you want to spend your April 19th all-day Sunday with us learning real estate, I'm sure you're going to be going stir-crazy by then if you haven't started already. We're going to have A-plus speakers talking about anything from, we're going to be covering multifamily to tax deeds to tax liens to, real estate agents to flipping to wholesaling, a ton of great stuff, ton of great speakers lined up and to benefit a great cause. We have shifted to 100% free. So if you're watching and you like what you see and you want to donate, please do. It's all going, like I said, to LLS, which is a cause near and dear to a lot of people's hearts, anybody that's been affected with cancer or not. If you want to go check that out, please go to lirealestaterevolution.com. Sign up. Like I said, it's free, but you will get an email with information and a link to go check it out on the 19th. Now that we got that out of the way, though, I want to bring our guest in. He's out of Boston. He's a developer. He's an owner, a really good real estate entrepreneur that's going to give a ton of experience and insights to what he's doing. I think give a lot of knowledge to a lot of people. So that being said, Ricky, thanks for joining us.
Hey, what's going on, guys? Thanks for having me.
Yeah, absolutely. First off, I should have asked this before we start recording, but do you prefer Ricky or Richard?
Yeah, Ricky, please.
Ricky. Okay, so awesome. Can you spend a few minutes just telling us who you are, where you're from, your background, how you got into this game, and what you're doing now?
Yeah, so my name is Ricky Beliveau. I'm the owner of Volnay Capital. We're based out of Boston. I actually grew up in Connecticut, went to school at Northeastern University back in 2005. My real estate journey started while at Northeastern. I had friends who were real estate agents and, kind of opened me up to the idea of that there was more to real estate than your primary residence. My parents growing up, we had our house and that was their only asset in regards to real estate. Never had any experience with owning real estate or rentals or anything like that. But, during school, I saw the idea of real estate agents. And then what really got me interested in the world of real estate investing was my senior year. I took a class on real estate finance. In that class, I actually analyzed rental properties and learned the idea of cap rate, cash up and cash returns, kind of analyzing a deal. And it opened my eyes up to the world of real estate investing. And at that point, I had kind of decided that although I was going to go into finance from, with my major, I wanted to do some type of real estate investing on the side. I would have never thought it would have grown to what it is today. But that was kind of when the whole thing started.
Awesome. And then just a little bit more. So from there, you graduated college, what was that process like going from college into doing real estate on the side and to now getting to where you are today?
So once I graduated, I started working at Wellington Management. It's a finance firm based, investment management firm in Boston. And then I wanted to get my first rental property, and I kind of had figured out that the best way to do that was via an FHA loan. So by using owner occ, you're able to use 3.5% down. This was in 2010, so the markets had been coming slightly up out of 2008, but it had still been pretty flat. During my capstone paper, I had realized that the cap rates in Boston had really climbed significantly. Rents were going up and up and up, and property values were staying flat. And so, especially in the areas of the colleges, a ton of people were starting to go to college. Colleges were growing. Everyone was going to go back to school. And so you were seeing these, kind of a bubble, a good bubble, for the fact that there was, rents had climbed and property values hadn't. So I then decided I was going to buy a multifamily. I found the one that I wanted to purchase, and I actually kind of did my own little analysis, and put it together. And I went to my mother and asked her if she'd want to do work with me on it. She gifted me the down payment funds, and that was kind of what started it all off. I paid $930,000 for a 3-family, which in most of the country, people are like, that's insane. It was at the time a lot of money. The building's worth $2.5 million now. So it had, I still own it. It has gone crazy up in value. But at the time I needed 3.5% for the down payment. And then I used a lot of money that I had saved up to do a renovation over that first year.
Awesome. Yeah. I think a lot of people, especially in like the podcast world and the online real estate world that we're in, a lot of people buy and invest not in major metros. So it's, paying over $300,000 per unit seems like a crazy amount, but depending upon, where expenses and cap rates were, and I don't know if you were even able to cut expenses at that time because you were going to operate while living in, I'm sure you were able to operate it for even cheaper than just, a regular investor off the street. So I think everyone's got to keep that in mind when they're hearing that. I'm curious though, before we get more into your story, you touched on taking a finance class with the real estate component to it. How much of that was transferable to, let's say your early years of real estate, and then let's say, now being, owning, probably millions and millions of dollars worth of real estate?
Yeah. So, I think it definitely opened my eyes to how to look at a deal in the right way and understanding how the financials should work on it. I look back to the way I analyzed deals back then, though, and I was definitely not doing as deep a dive as we do today.
Sure.
Right. And, when I look at something now, I'm doing a much deeper dive into, if this is going to be the right purchase. I was still just kind of winging it back then. And so I think it kind of opened up my eyes to what could be done. But I should have been doing, if I had taken everything I learned in the class and actually applied it, I probably would have been even better off. But I think the key is to just start to understand, how to analyze a deal, and then that will really allow you to then build your business.
Yeah, for sure. So then final step, how do you go from one house hack in Boston in 2010 to in 2020, developing multi-unit properties, managing for all these people, having your own brokerage? What was that process like?
Yeah. So, I think that's one thing I like to remind people, that it was a long journey, right? It's been 10 years.
Yep.
So it doesn't happen overnight. I bought my first building in 2010. I bought my second building in 2012. I bought my third building in 2013, and I bought my fourth building in 2014. So over 4 years of buying, it took me 4 years to buy my first 4 buildings. And
all with your own money or family money?
So first one was a gift from my mother. Second one was my own capital. Third one was my own capital. And then my fourth one was my first development deal, and I partnered with my father.
Gotcha.
And so, it kind of, you can see it, kind of slowly grew. And then, I made the jump on the fourth one, which was my first time doing a condo conversion.
Awesome. I think that's awesome. Was there anything in your background that gave you the confidence to take on that condo conversion or development? Or was it, how do you jump from just owning rentals and buying rentals, and maybe one was like a very distressed situation that was kind of like a step up into it, but what was it that helped you, or maybe there was nothing that got you there?
I mean, I think anyone who's getting into this business, I always recommend that you should buy something that needs a cosmetic update to increase value on your first couple deals.
Mm-hmm.
Right? When I say that, that means paint, floors, kitchens, bathrooms, right? If you can stick to those type of renovations on your first deal or two, you're going to get a lot more confidence when heading into the bigger projects. So, that's how I started. My first 3 projects were cosmetic renovations.
Mm-hmm.
And then what that gave me is the knowledge and the relationships to then make the jump into doing a full gut renovation of a 3-unit building. And, it was a $380,000 renovation.
Mm-hmm.
I think, you need to properly go through that learning curve. And, there are people who just jump right in, and that's great as well. It's just, I personally feel like, the best way to do it is to scale your way up.
No, I agree. Go ahead, John.
I get that question all the time, and they're like, well, how do you know it's going to cost $2,000 for cabinets? I'm like, because we've done so many of the exact same thing. And people, I think they discount that approach. Everybody wants to dive in and develop a 300-unit complex in downtown Manhattan, right? It's sexy. It's attractive. Unfortunately, there's a lot more mistakes that go wrong. And that approach is something that, when we're doing a turn and, like you said, that cosmetic stuff, that is what it is. And, when we used to have our meetup groups, 3-4 years ago, and people would come up to me, I'm like, go to Home Depot, go to Lowe's, just look at what stuff costs. Then when you go do your cosmetic updates, that stuff's going to be the same. It's always the same. A cabinet is a cabinet. And, the flooring is the flooring. The price for vinyl plank floor is vinyl plank floor. So that should not be taken lightly. And going through that process on a couple deals, it'll give you so much more confidence to and understanding to go do, a significantly larger project. So I'm a firm believer in, and there's nothing wrong with diving in head first. And I'm like that, but there's something to be said about doing the same thing over and over again and getting really good at it.
Yeah. And I think when you look at it really comes down to the percentage of error, right? When you mess up on a $100,000 project, you mess up by 10%, that can happen very easily. Mm-hmm. It's $10,000, 20%, $20,000. Okay. Now you start getting into looking at a project and you're saying a $300,000 renovation, $60,000. If when you start looking at getting, you start making mistakes and things go wrong. Now you start getting into $1 million project, right? Now look at the swing, $100,000. Do you even have the liquidity to cover that? Mm-hmm. And if you don't, and the bank won't give it to you, you're fucked. Mm-hmm. And, and so, and then we have a project now with a $29 million budget, $29 million. You start to miss on that, it's over. So I think it's the idea that as you learn how to scale your business, you're able to then bring that margin of mistakes smaller and smaller. And what we do now is we have so much data that we've collected from these ground up construction projects. We're able to project without even having subcontractors quote it. We have the idea. We know what it should cost because we're able to look at our past 6 builds and say, well, we budgeted this wrong. This one was off. This one was off. Let's tweak our formula, and we can see. And so, as you get into the business on your first one, you're going to really be flying by the seat of your pants. Once you've done 2 or 3, you keep that data compiling. And I think that's something that I didn't do a good job at, as good a job until recently in the past, year or two, is to really keep all that information of where exactly everything is costing you so that when you're analyzing the next deal, you can be spot on.
Yeah, I think that's huge. Because like you said, if your first deal is in this example, a 3-unit building that you're going to do cosmetic upgrades, call it $5,000, $10,000 a unit, whatever it is, might be more expensive in Boston. You can float that with, if you're off by 20%, you can float that through the cash flow of the other units. It's not ideal, but if you make that big of a mistake on a 3-unit with 2 other units rented, it's not the end of the world. And by the time you get that 3rd unit done and rented up, you'll survive it over a 5-10 year period. But now if all of a sudden you decided to build 3 units out of the ground day one and you're off by 20%, well, where's that money going to come from? That 20% overhead is going to be significantly more to go get. Like you said, now if you have the liquidity and it's a non-factor for you, that's a different story. But it's two very different things. And you start to learn the business of, subbing things out and getting contractors and getting bids and, the intricacies of different bids, not just the price, but is it, a guaranteed max, or is it different types of things? And what does that mean for how you're going to allocate the money? It's a lot of stuff I barely even know. And, I'm sure John and know it significantly better. But those are the things you learn over time by doing smaller projects. And you take that knowledge and those mistakes that you made and you carry it over into bigger projects. I'm sure, you just alluded to, there's probably thousands of mistakes that have helped you fine tune everything you do to allow you to build up to doing, a $29 million project, which is amazing. So you obviously started getting into the development side of things. When did you transition full-time into this and out of that finance job? And then how have you been able to build so many different components to your business that all play off one another, but obviously all require slightly different hats?
Yeah. So, so once that first condo conversion was a success, that's kind of what opened my eyes. And people will say, well, why'd you even do that one? I did that out of necessity to pivot because I realized that continuing to acquire rentals is very difficult. It takes a very long time without any influx of liquidity. Mm-hmm. And I also noticed that the market in Boston had continued to climb in value and that the cap rates were getting smaller and smaller. Mm-hmm. And so I was getting outbid by people and I'm saying, how are they paying that? And what it was, they were paying cash or they didn't care that the cap rate was small. Whereas I was looking at it, I'm like, I want to be making $1,000 a unit a month. Mm-hmm. And or something, because that's what I was getting on my other properties. And that was never going to happen. So what that allowed me to do is say, okay, well, let me pivot into doing a condo conversion, and that would give me the influx of capital. So once that was a success, I ended up doing two additional condo conversion projects. And then the third one that I actually completed was a large one in East Boston. And that's actually where I blogged it on Bigger Pockets. So I wrote throughout the whole process. I was blogging it, still working full time. And that project is when it was a huge success. I think the profits on it were like $460,000. Mm-hmm. And it was a huge success. And it was not only that I learned a lot, had a great team in place by then. It was also the market took off. I mean, I bought it at a price where it was all, and then the condo market went through the roof, and I just happened to time it where I originally thought I was going to sell the condos for $490 and they sold for $600. Right. So,
it's a nice bump.
Yeah. Huge, you're having huge jumps, and it should have profited like 200,000 and it made almost 500. Mm-hmm. So at that point I realized that it was time to, do this full time. And that's when I left my finance job and jumped into this. One thing that people should realize is that like the fact that I worked in finance for 6 years, and this was in 2016 when I quit my job, that W-2 income alongside of owning a lot of rentals and alongside of having, development projects have hit my tax return is what allowed me to get loans while I quit my job. So be very careful about quitting your job after the first successful development deal. And then the bank is they're not going to give you credit for that money when you go to get the next loan. They're going to say, well, what happened to your W-2 income? You're like, oh, I just made 60 grand. I quit my job. They're going to say, that doesn't matter. We don't care. You just made 60 grand. So, keep the job if you have it until it's really the right time. And so at the time I left my job, that allowed me, that project was my first time using a commercial lender. So that was my first time having someone finance 75% of the acquisition and 100% of the construction. Up mm-hmm. until that point, I'd been getting loans for just 75% of acquisition and doing the renos with my own cash.
Okay.
So I had cash out refinanced buildings, my rental buildings I bought early on in my career, and then used that capital and then the profits from the other projects to fund the developments. Gotcha. And it came to this time, and my commercial lender was like, No. We'll hook you up. You've got experience now. You've got a good track record of a couple of years of experience, 75% of acquisition, 100% of construction. And I went, now instead of doing one per year, 2, 3. And that allowed me to jump the business. So I quit my job. And then at that point we had 3 projects that we started up. All the same condo conversion projects.
Awesome. And when you're saying condo conversion, I just want to make sure I have it right. It was a multifamily permitted building that you then made nicer and then sold off as individual units as condos, correct?
Correct. So in Boston, and this is something everyone should always pay attention to, just because I can do that in Boston, it doesn't mean you can do it where you are.
Yep.
So be very careful. Talk to your planning department in your town. Talk to the people in the building department. Talk to a local attorney. Make sure that they allow you to do this. But in Boston, if it's an existing multifamily, so 3 units, you can just submit updated paperwork to the Registry of Deeds, and you can change the occupancy from it being a rental of 3 units to like a single deed with 3 units to 3 deeds with 3 units.
Oh, wow. It's that simple. It's not like a whole big process of plans and stuff like that.
Yeah, I mean, you need,
well, for the permits, right?
Yeah, to submit, you need a set of plans. You need the condo docs. You need the survey. But there's not any like presentations to the city to ask them to let you. You can just do it.
Awesome. That's incredible. I mean, that's a really interesting story to see how you've kind of fallen into it. Because I know when we've looked at some deals, because we're multifamily syndicators, we've looked at doing the opposite, where it's a partial, it is a condo association, but someone owns, 60% or 70% or 80% of the units. And then you can go in, buy the remaining condos and actually dissolve the HOA and do the reverse. So you take the condo and down into multifamily. And John and a couple of his buddies actually did the one that was super successful down in South Carolina. So it's interesting to hear the reverse being done. Just quickly, because I'm curious, how has it been for you guys in the development space over the last 2 to 4 weeks, or even 1 to 4 weeks?
So we have projects located we have 7 active construction sites right now. 6 of them are in Boston. They made an announcement a couple weeks ago that all construction had to stop. It was like a couple Fridays ago. So most of the Boston sites came to complete stops at that point. We had a little bit of relief on some roofing, doing some roofs and some windows and stuff, because they claimed that as emergency work so we could get the buildings weather tight. But At that point, we had to stop all construction. And then as of yesterday at 5 p.m., our project that was outside the city in Everett, that one, they requested we stop work as well. So as of right now, we have 7 sites sitting empty.
How are you guys holding up with that?
So, I mean, it's, it sucks. It's going to affect the timelines, going to directly affect the ROIs on the back end of these things. I mean, when carrying costs on some of the larger ones are 5 to 10,000 a month. And so, you start to see that money disappear. One thing that's good for me, and then I think is, kind of at first you might say, why do you do this? And now you see why. So interest reserve accounts. One thing on all my deals, we have interest reserve accounts. The banks require me either to fund an account at their bank for interest payments at the closing, or they finance my interest payments and they fill the account for me and they draw it down as I need it. It started out, I had to fund them myself. And now, because I've been in the business for so long and the track record, I'm able to request that they fund the interest reserve account for me. What that does is it allows me now to not sit here and freak out about where am I going to come up with 50 to 100,000 in interest payments each month. Those are already funded in my loans or in my bank. So those are going to be taken out, but they're not coming out of my direct operating account. And it's kind of a safety net that they put in place. And now I'm pumped about it. Back in the day, I used to be like, well, I'd rather not put the funds in if they're not going to finance it for me. But now looking at it, it's great that those are there.
Yeah, I know, John, we have something very similar on Kimberly, right?
Yeah, Kimberly. Yeah, we have a couple deals where depending on the size of the project, but they do it. And we've been talking to all our managers and our investors and everybody, and we said, hey, listen, these projects have, I don't want to say little to nothing to worry about, but the heaviest expense that you're going to have on a monthly basis is that interest cost on your loan. So these deals have the built-in protection where, now the timeline may be thrown off, but you'll pick the construction up again in the future. But for now, these payments were going to be paid anyway with the money at the bank. So it's not the end of the world. And, Aston Villa and Kimberly both have it. Kimberly's fine. We have payments backed up. Aston Villa actually had a couple months of payments. So I don't want to say we're not worried. There's worry for other reasons on leasing and occupancy and stuff like that. But from a standpoint of construction, it's the best thing in the world when you can build that security, and because you're not having to come out of pocket month after month, on some of these projects, $5-10 million renovation, $30 million renovation, those payments can get, relatively expensive. So, but yeah, we have the same protection and feel really good about those deals.
Yeah, I think it's something, for someone as you're getting, early on, you're probably not going to get them financed. But if they are asking for an interest reserve, this is a lesson for everybody that if you're doing a deal and you're raising equity, raising that extra, 10, 20, 30K to put into the bank to take care of interest payments as a safety net isn't, it's not the end of the world. So just raise that equity from an investor, pay him his return, put it into the account. And then once you're at the point where you can finance it, negotiate it as long a timeline as you can. Right? If the project's going to take 12 months, ask for 18. If it's going to take 15, ask for 24. And these are things I'm going to start paying much closer attention to. This has taught me that, right? Is to not, add those the additional timeline doesn't cost you anything. It does until you draw it down. It doesn't cost anything. So just to put that extra 5 months or 6 months that's allowed, it's what you should do.
100%. It's one thing that this, economic hardship and, whatever's going on, I think it'll make people realize those things, showing an IRR and a return on paper is great. I'd rather have more cash in my bank and show a lower number and have some padding and or an extra couple months or so on the interest reserve, because it's better to not be wrong than to cross your fingers and be right.
Yeah, I think that's hugely important. And just for anybody listening, and Ricky yourself, the two deals he was referencing, one's a 130 unit deal we bought completely vacant. The other one was, what was it, like 85% occupied when we bought it.
Yeah.
And they were both same type of loans as you. I think 75-80% of purchase.
Let me grab this coffee.
Yeah, of course. And 100% of renovation, future funded as well. So it was just really interesting to hear you talk about that. And now, obviously, as John leaves, we realize, this stuff is still going on, and got to figure it out. How do you manage all the different aspects of your different businesses as, the CEO? I don't know if you have other partners or not, but as, the head of all these different businesses and different moving parts, can you talk a little bit about, your day-to-day or your setup of how you manage to stay on top of all these different aspects and different moving parts, so that nothing really falls through the cracks?
Yeah. So on the development business, I think it's key that I work with a general contractor. So EJO General Contracting has actually been my partner on these development deals since I started doing the gutting of 3-family buildings. So
okay.
He came on board. It's still set up as a cost plus, so he gets his GC fee on the deal. But we are now business partners in my real estate brokerage. So we own a brokerage together with a third partner. And, so we run the brokerage together. So having him take the responsibility of everything that occurs on the job site falls under his scope. So I don't have to be responsible for the subs or the inspections or anything that's going on at the job site, which then allows me to think bigger picture, keeping the pipeline full, analyzing deals, working with architects, attorneys, engineers, getting stuff permitted, kind of big picture stuff for the business. I also have a kid, someone who works for me at Volnay Capital. He oversees all the budgeting, timelines. If a deal comes in, I shoot it over to him to do the analysis, so he handles all that. So that allows me to, our monthly email updates, all the stuff that needs to be done to run the business properly. He handles that stuff for us. From the management business, we manage about 350 units, my own plus other people's rentals plus condo associations. So that's run by me and my wife. She does all the accounting and the bookkeeping, paying the bills and that side of the business. I handle client relations and anything with the tenants and any maintenance and that type of thing. It's all based on systems, though. I mean, how do you manage 350 units? Well, we have a platform that allows people to submit all their rent, their condo fees. It all happens automatically. That all then gets automatically updates into accounting. So I'm not there putting checks into the account. I'm not collecting condo fee checks. It's all automatic. When they call the number, it goes to an answering service. The answering service then will actually ping a contractor directly if it's off hours. So if there's a plumbing emergency, they'll ping them directly. If it's not an emergency, they send me an email. Right. So I don't get phone calls. So it's like someone needs something for one of my units. I need to speak to someone at Volnay Capital. Is this an emergency? No. What are you calling about? And then they type it up, put their email address, and send me an email. That allows me throughout the day to not have to worry about those issues. I get to my computer, I can rip through everything that came in. And most of that is stuff that I can just loop in different contractors and say, hey, take care of this, take care of this, take care of this. So that's kind of how we scale the management business.
No, that's awesome. I think it's so important to, as you figure out and build out different systems that allow you to leverage, not only technology, but other people's time and resources, because it allows you to focus on, the things you need to focus on. Like you said, the big picture and, putting these deals in place to continue to develop them, move them through the pipeline and things like that, and manage the rentals you already have. So I think it's such an important factor that I think a lot of people don't account for as they think about building and scaling and stuff like that. And I also think it's really interesting to hear that you've started to bring in partners into these different other aspects of what you're doing. Because for me, especially I want to say 2-3 years ago, I always thought why would you ever, if you're building a business and then you bring in different offshoots of what you're doing or different businesses, why would you have partners when you can just hire someone to run it for you? And I never really understood it until more recently, where I've started to actually experience I'd love to start doing this. I'd love to start doing that. And there's a real benefit to not only giving up ownership and giving it to someone else as a pride and they're going to stick around and work for it and build it for you, but just also that responsibility offload, like you said, I think is a huge component. So how were you, obviously you said your wife on the management side, I'm sure you obviously knew her very well going into it. How were you able to find different partners? I know you said the one was your contractor who you had worked with for a number of years. But in other regards, how were you able to find partners, vet them, and then, commit to something as much as, giving them a stake in, the company or that arm of the business?
Yeah. So, other than Volnay Capital is still a sole entity of just me. That's the major business and the rental business and the development business. But when it came to the brokerage, what I was looking for is, I kind of looked at I wanted to build a management business as my next step. It was, I already owned a lot of rentals, and I felt that the proper next step would be a management company, manage my own, which then I grew into managing others, and was a good business for downturns. Right now, it's still, management fees are still paid.
Yep.
That business it's exactly the reason I built it, was for when this happens, is we can still make a great revenue coming into the company based on the management business. When it came to the brokerage business, I was talking to my general contractor, who's still his own entity. So he still owns his own general contracting, builds for me, builds for others.
Gotcha.
He and I were talking about starting a real estate brokerage. And we were like, well, okay, let's do it. And we said, but I own a development company. I want to be part of this. I can feed the business. I can feed it with leads. I can feed it with rentals that can be rented or condos to be sold. you own a general contracting business. We really do need a third partner here who's going to be the managing partner, who's going to be the face of this thing. I run my business, you run your business. So that's when we started Evo Real Estate Group. We approached Ryan Aconi, and he was looking at starting his own brokerage, and he's someone that I've known for probably 4 years. He was a developer doing projects. Him and I had become very close friends. And I trusted him, and I knew who he was and who his background was. I don't think anyone should jump into partnerships with someone that's just, someone you just met. So I'd known him for years. I had known Jack for 5 years. And, that's when we decided to start the brokerage together. And I think we realized that all of us had different strengths that we could add to the business. And so that's kind of why it all worked out. What I recommend for partnerships is go deal by deal. You don't have to bring a partner into your company. Your company is your business. So if you're doing a deal, you set up your own LLC. That's you. And then you can let your partner have his LLC. That's him. And that deal, you guys split 50-50. If it goes really well, you do another deal and you're 50-50. And then if it gets to the point you both look at each other in 3 years and you say, this is stupid. We're doing every deal together. We trust each other. Let's just form an entity together. Then you can go that route. But for the short term, everyone should have their own business. You don't need to start a business with partners.
No, I think that's really interesting to hear. And it's a lot of parallels between John and Don, who's the other owner of Toro. So John, I don't know if you want to chime in a little bit.
Yeah, I was going to say, I could not disagree with anything there. I mean, to a point, even Toro, it's technically owned 50-50 by our two LLCs. It's, now every deal we do now is together. But prior to that, we worked together for 3 years before we fully incorporated Toro. And it was just, let's marry before, let's date before we marry. And even to this day, there are things that, things happen and things go on, and you're not tied to anything. If you wake up and get into bed with someone right away, whatever their problems are now your problems, and vice versa. So I agree 100%. I think that, do it deal by deal. For as long as you need to feel comfortable, where you can go to bed at night knowing things are going to get done, and trusting they're making the right decisions when you need a quick answer. But I agree 100%. I think that, that's the way it should be done. Just do it deal by deal. And even if deals come in now and if I don't like them and Don does, hey, if you want to do it, and vice versa. There are deals that, have come in that we've passed on, but, I've helped someone raise money, or I've not necessarily helped someone raise money, but, it's, oh, hey, call this mortgage lender or do this. And, if you could add some value and get compensated in some way, shape, or form, go for it. But it doesn't have to be a complete marriage until the time in the future. But then after that, then, by all means, jump into bed. But for sure, do it together at first. Do deals to make sure you guys have a good operating understanding and, level of, get along before you just dive into bed.
Yeah. And, once you start adding multiple layers to an LLC, things get very complicated. So banks, when you start saying it's there's two owners, well, then every single time they're going to want to know what each owner's financial situation is if it's a recourse loan. So then you want to do a deal that's your passion. The other guy's putting his credit on the line. So it's that whole level of trust. So there's really no need until it gets to the right point.
100%.
Yeah. John, I know because you had several, like you said, deals where you had different partnership structures with different partners. Is there anything you can talk to about like the good, the bad, and different structures and the types of people maybe, or anything like that?
Yeah, no, the bad part is just, when too many cooks get in the kitchen. I think a good partnership, everybody knows their role and everybody takes their responsibility. When everybody wants to be the boss, it doesn't work, because inevitably, you'll do something better than somebody else, and someone might do something better than you. And I think the good partnerships are the ones that understand that, where, you're really good at asset management, you take that. I'm really good at acquisitions, I'll do this. You're really, whatever it is. And I think I'll say the bad partnerships, and I haven't had bad partnerships, right? All my, they've run their course and they've stopped, and I've stopped doing deals with people. I won't let people invest in deals now, but it wasn't, they ran their course, and you could tell that they were dying down. When, like I said, the biggest thing for me is when everybody wants to be the boss and everybody wants to be the face of the franchise, it doesn't work. There's someone that's going to be better talker. There's going to be someone that's better at underwriting or whatever it is. So the ones that haven't worked is when, everybody wants to be involved in the flooring color and the cabinet color. It's like, listen, what's it matter? Go do it. I don't care. I have no interest in, white, black, brown, turquoise cabinets and doors. And it's okay. I can part with that decision. The good partnerships are the ones that everything of opposite of what I just said, they fell into place, where they're really good at managing the finances. You're really good at the relationship side. Those are the ones that work, and you can do deals forever with, when everybody knows their role. I know the deal that we did that Chris was referencing, the condo conversion, or the old condo back to multifamily.
Condo deconversion.
Yeah, condo deconversion. That deal was done with two people that we've done a lot of deals together. Some deals we do together, some deals we don't. We JV on a ton of stuff, but that was a deal that I know I didn't ever have to be on a management call. I didn't ever have to look at the bank account. I'll go one further. The God's honest truth is, when we did the deal, it was a Wells Fargo bank account. There was no Wells Fargos near where I was. For 2 years, I never went to the bank and signed the paperwork to get access to the bank account. But the level of trust was so deep, and understanding of whose role was what, that I never even questioned it. And the deal ran it was our best deal to date, and still, and probably will be the best deal we ever do. But it was just the level of trust and what everyone brought to the table. We all knew our roles. And when you know your role and you execute on that, the partnership works out great. I would say that's my biggest piece of advice. Like Ricky said, just, don't dive in head first into bet on a partnership, because you're setting yourself up for failure.
Yeah, I think one thing you want to look at too is look at someone's overall values, overall, how passionate they are about this business. Where does it align in their life, and kind of their values when it comes to accomplishing goals? Because if everyone has the same at least passion to get this thing to the finish line, I've seen so many partnerships where that falls apart. If someone's not fully committed, the other person is and has a different, I will do anything possible to succeed. The other guy's a 50-50 type of guy. Those type of guys don't work well together. So make sure when you're working with someone, you'll quickly realize if they're 100% or if they're 50-50. If you're a 50-50 and they're 50-50, and then you both are doing other stuff and it doesn't matter, that can work. But just figure that out before you go into a long-term relationship.
I agree.
Yeah, I think it's interesting too. I think one thing that I had always thought about, and I think it's probably on a lot of people, is like that relationships and partnerships either have to work or it's going to be a problem. And I think after now doing this for several years and seeing several different partnerships, John, how you alluded to, like you said, you haven't had any bad partnerships. They just haven't worked out, and they've just kind of fizzled out, and just nobody left on necessarily bad terms, but it just wasn't right. And you just all moved on for one reason or another. And I think that's one of the things that I've realized a lot. It's, just because you do a partnership, not necessarily start a company together, but a joint venture or whatever, just because it doesn't work or it's not 100% right doesn't mean it has to be a bad partnership. It can still work and do what it has to do and go its course, but it doesn't mean you have to continue on and continue to do deals together going forward, or different opportunities or things like that. And you can still have a really good relationship outside of that. So I think it's been interesting to see some of the partnerships and stuff, not work, but just not continue on. So I always thought that was interesting.
It is, because like you said, if you dive into a company together and you start branding everything, that is when divorces happen and bad things. I've seen that. I've seen, two people that got along great, but one guy had a passion and the other one didn't. Those end poorly, because now you got to wind down deals and whose investors are whose and what's this and how do you compensate that. That's when it gets ugly. But, you joint venture on a deal and you have a single purpose one-off LLC, you're going to realize right away if everyone's got the same vision. If they don't, it goes its own way. The deal stays involved and it runs its course. but it doesn't mean you have to do another deal. And I think that's important to realize, that you can do JVs and it doesn't mean you're getting into bed with someone. And it's a better way to go about something and really find out the way people work when the pressure's on, as opposed to just, this is going to work because we met at a fix and flip boot camp and we lived down the block from each other, doesn't mean you should do a partnership, because there's a lot of things that go into it. And I think Ricky was 100% right. Just, if everyone's committed, that's great. If one person's not and one person is, test it before you dive in.
Yeah. Awesome. Ricky, as we're wrapping up, what's next for you going forward? What are you working on? What do you see? And not necessarily with this, pandemic or whatever, but beyond that, like, what are you looking at? What are you thinking of doing? What's the future hold for you?
So, I think it's, it's kind of been a slow, like I've said before, it's been a slow and steady growth of going from, buying rental properties into bigger developments. So now starting in, looks like January 2021, we're going to break ground on our 85-unit rental building. So that it will be ground up construction, restaurant, retail. Really excited about that. And then also in the pipeline, we've got another 30-unit, a 40-unit, and a 60-unit projects in the city. They're all in early stages of neighborhood meetings and zoning. So hopefully one or two of those, if not all three, end up coming to fruition. And that's, in this business, it's in our world, when you're doing deals that are contingent on zoning approvals, you have they could turn into nothing, but continue to do the smaller 4 to 10 unit developments, and then start shifting into adding, 1, 2, or 3, 30 to 150 unit projects in and around Boston.
Awesome. For those projects, are you using your own money again, small partnerships? Are you raising money? How's that been looking?
So for the large projects, on a large project like that, it's a whole new ball game of figuring out the financing. So we are in the process of raising. We've hired a broker who is overseeing the process, but we need about between $7 million and $9 million of cash, so equity, to come into the deal, and then we'll be getting about $21 million of a bank loan.
Mm-hmm.
Investor capital. So that's, that will be coming in from different sources.
Gotcha. And so when you say broker, you're working with like a broker dealer or like a mortgage broker?
So a broker as a financial broker. So pretty much what these guys do is they specialize in raising bank debt. So equity, either bank debt or equity from institutional money or family offices or high wealth individuals. So they'll charge a fee and they'll bring in, they'll raise the money. So they pretty much underwrite the deal. They bring it and present it in a format to these, family offices or whatever, and have them put up the capital. And then they oversee all the paperwork and all the deep dive, stuff that goes into actually getting the funds into our account.
Awesome. And what's that process been like for you?
So, we're just a few months into it right now, so we'll see how it goes. Up until this point, I've used all my own capital or investor capital, but the investor capital has all been friends and family. And so we've handled the relationships directly. We've done all the contracts ourselves, and we've done all that. So it's a different type of setup. If anybody out there wants to get information on our projects, you can reach out on my Instagram. It's Volnay Capital. And we'll add you to our monthly email list. It goes over all the projects that we have under construction, all the stuff we have coming up. And then when a project comes to the point of raising capital, we typically send that out as a friends and family list, so people can, kind of see what we're working on. Awesome.
Yeah. I was going to ask where people can reach out to you. That's awesome to hear. I mean, I saw the renderings and the process you guys were going through for that project. It looks awesome. It looks so cool. I'm really excited to see how it pans out. So I'm definitely going to continue to follow along and see how everything goes. But Ricky, thank you so much for coming on. I think you dropped a ton of knowledge, experience, expertise for people to really get a ton of benefit from. So thank you for that.
All right. Great. Thanks, guys. Thanks for having me. Stay safe.
Yeah, you too.